Hello everyone, in this session we will first see the topic evaluation of funds raising through debentures. Now in our previous session we have understood what is debentures. Now in this session we will see what are the merits and demerits of raising fund through debentures. Now first let us see the merits. Now first is availability of necessary funds. The company can raise funds by the issue of shares if funds are not available by the issue of shares. Now in these shares we mean equity shares. Now a company has other options, like if first they will issue equity shares, and if the amount that they have raised through issue of equity shares it's not sufficient, then they can issue debentures and they can raise as much capital or as much funds they need. Then next is non-interference in the management. As we know that equity shareholders, they take part in the decision making, but in case of debenture holders they don't have any voting rights, as well as they cannot participate in the management, means they don't have any say in the decision taking process of a company. Third one is fixed rate of interest. Now this merit is from debenture holders point of view. Now company, even if though they are suffering from loss, they have to pay a fixed rate of interest on the debentures. As we know that in equity shares it is up to the company whether they want to issue dividends or not, but in case of debentures they have to pay certain fixed rate of interest every year, even though they are not earning any profit. They have to arrange those interest from somewhere. Then the fourth one is facility to return loan. The company can return funds to debenture holders as per agreement and relieve itself from the burden of loan. Now debentures is a kind of loan for a company, means they are taking loan from the debenture holders, and at certain point or according to their agreement they can repay back that loan to their debenture holders anytime they want, and they can reduce their burden of loan. Then the next is regular source of income. This merit is from debenture holders point of view, means since debentures carry a fixed rate of interest, then it is a regular source of income for those who hold debentures of a company. They don't have to worry about whether a company is earning sufficient profit or not, because even though if a company is suffering loss, they have to give interest on the debentures. Then the last merit is safe and secured investment. Debentures are issued against security of asset, means to issue debenture a company has to keep some of their fixed assets as security, because even in the case of dissolution or any other bad situation, a company, they can sell off their fixed assets and they can repay back the loan that they had taken from their debenture holders. So it is kind of safe and secured investment for the debenture holders, because even if the company is suffering loss or planning to dissolve their company, they can assure that they will get back their money. Then let us see some demerits of funds raising through debentures or bonds. Now first one is fixed charge. Now this is the most important disadvantage of a company, means if they don't have sufficient profit to give interest to their debenture holders, what they have to do is that they have to sell off some of their assets, or they have to take out money from their reserves to give interest to the debenture holders, because they have to pay regularly and at a fixed rate to their debenture holders. The next is pledging assets, means for raising fund through equity they don't have to pledge or they don't have to mortgage any assets, but for raising funds through issue of debentures they have to keep some of their assets as security. Okay. The next is no participation in the management. Debenture holders, doesn't matter how much amount of debentures they hold in a company, they cannot participate in the management. They don't have any voting rights. Then from this portion you can say that issue of equity, then preference shares and debentures are the main important sources of raising finance for a company. Now evaluation is given for these three types of shares in a table. You can give it a look. Then now let us see what is meant by public deposit. The amount deposited by the public with the company for a specified period at the predetermined rate of interest is called public deposit, means the amount of money that public they keep or they deposit in a business for a particular period of time and with at a particular rate of interest is nothing but known as public deposit. Just like when we deposit our money to the bank, a company can also take public deposit. During 1930s, public deposits were important source of financing the textile mills of Mumbai and Ahmedabad, and in the tea estates of Bengal and Assam. These days, public deposits as a source of finance have also become significant. Many joint stock companies have been issuing advertisement and inviting public deposits at excellent rate of interest. Earlier, during 1930s, it was very popular in places like Mumbai, Ahmedabad, Bengal, and Assam. But nowadays, even some of the companies who have joint stock who are joint stock companies, they used to give advertisement and they invite public deposits with good rate of interest. The method is becoming popular because it is easy, economical, funds available without mortgaging assets. Now remember that when the company invites public deposit, they don't have to mortgage any assets or they don't have to keep any assets as security, and non-interference from the investors means the investors, those who give public deposit with a company, they cannot take part in the management, just like debenture holders. Now, what are the special features of public deposits? Let us see. Deposits are accepted for specified period for at least 6 months. That is means the public deposits can be taken for minimum of 6 months and maximum of 36 months. Then deposits are made generally in the multiples of 1000, means you cannot deposit 100, 50, 20 rupees. You have to keep deposits in terms of thousands, like 1000, 2000 and maximum. Then no security is offered to depositor, means those in debentures, the debenture holder, they get security, but in case of public deposit, there is no security for depositors. Then interest is paid either monthly, quarterly, half yearly, annually, or at the expiry of the period as per agreement. Maximum rate of interest is 15%. They cannot give more interest than 15%. Then at last, public deposits are cheaper than bank loan for the company and fetch interest at rates higher than deposits with the bank. Means for a company, taking loan from a bank is much more for a company, taking loan from a bank is much more expensive than taking public deposits, and the interest rates are also higher than deposits with the banks. Okay. Then next is advantages of public deposits. Now, what are the advantages for the company? Easy and economical. It is a simple method where the public make deposits at their own will. The company cannot force anyone to keep deposit. It requires the least paperwork, printing and correspondence. Now, compared to depositing money into the bank, depositing money in company is very much economical, means it has less paperwork than printing and correspondence. You don't have to give any correspondence or nominee. Okay. Issuing shares and debentures is very costly, means to issue shares and debentures, it is somehow costly, means they have to spend a lot of money while raising funds through equity shares and debentures. But compared to public deposits, public deposits are cheaper as other methods of raising funds. Then next is loans without mortgage. The company is not required to mortgage its assets with the investors, means they don't have to keep their fixed asset as security. Deposits are made by the public at their own will. Then next is non-interference in the management, means the depositors, they cannot interfere in the working of management, and the company, they can carry on their work smoothly. Then higher dividend rates. The company procuring funds to public deposits earn profits at higher rates than the interest rate. The extra earning is used for declaring dividend at higher rates. Means the company, those who raise funds through public deposits, they earn more profit, and they can give, out of that profit, they can give interest to the debenture holders, and the extra amount that they have left with them, they can declare their higher dividend for equity shareholders. Now let us see what are the advantages for the depositors. The first one is the depositors, they get interest at higher rates. Generally, the rate of interest on public deposits is higher than the rate of bank interest. When you compare interest rate of bank to company gives higher rate of interest. So instead of depositing it in your money into bank, you can deposit with the company. Then next is safety with regional development. Public deposits these days are safe because the company, in an attempt to build its reputation, fulfill its obligation, means a growing company, they do anything they can to build its reputation, to build its goodwill. So deposits are generally made with the regional industries, which results in their growth and development. Because since India is a developing country, and companies, they ensure that the region around them is developing, so the depositors, they are very sure that they will get fixed return on their deposits. Now let us see some disadvantages or demerits of public deposits. Now let us see first the disadvantages for the company. Uncertainty. As we all know that business world is uncertain, we cannot predict future, we cannot say what will happen in future, so anything adverse things can happen. The public deposits as source of financing is not dependable. These deposits are rightly said as fair weather friends. Depositors are given option to withdraw money at any time by giving short-term notice. Withdrawal of deposits during the period when the company is financially unhealthy makes the financial position of the company worse. No long-term financial policy can be based on the public deposits. Means since public deposits is for a short period of time, as we have seen that minimum 6 months and maximum for 36 months they can deposit money. So you cannot rely for your long-term financial investments out of these public deposits. You have to go for short-term needs of the company. But the public deposits, it's not dependable because it is said that fair weather friends, means if the situation around your business is favorable to your company, then people will like to deposit money. But as soon as the factors are not favorable in your side, then the people will withdraw their money from your company. So it is very uncertain, or it is not dependable. Okay. The next is overtrading and speculation. The management of the company may indulge in speculation and overtrading with the surplus funds easily generated through public deposits. Sometimes surplus funds remain unutilized, resulting in unnecessary burden of interest. Means sometimes what happens is that people, when they deposit money into the company they used to take in, but sometimes it becomes overtrading. Means the amount that you need, you receive more than what you actually need, and in that case the extra amount that you have raised through public deposit keeps unutilized, and on that unutilized fund also you have to pay interest. So it is an extra burden of interest into the company. The next is discouraging organized capital market. Now public deposits are not part of the organized market. Organized market means stock exchange, where you can purchase equity shares, debentures, preference shares. But taking deposit from public, it is not a part of organized market. Availability of easy funds through public deposits discourage the growth of organized capital market, that is obtaining funds through issue of shares, debentures, banks and financial institutions. So public deposit, they discourage this issue of shares, debentures, banks and financial institution loans. Now let us see what are the disadvantages for the depositors. The first one is possibility of cheating. There is every possibility that the company may depict its rosy picture, make lofty claims and offer interest at higher rates. The funds procured may be misused, lost in the speculative business and the innocent investors cheated. Means a company, they will show you good picture of the company. They will say that the company has goodwill, it has high reputation, and through that they can lure the people and public. They will invest in the money, and later what the company can do is that they can run away, they can misuse that fund, or they can lose in speculative. Speculative means raising fund from somewhere and investing it in somewhere else to get higher rate of interest. So that time the funds can be utilized and can be misused, and innocent investors, they will be cheated. The next is no security. The public deposits are not secured as no assets are mortgaged against it. Consequently, the insecurity prevails. Means when you deposit money into a bank, you are secured. You are satisfied that your money is in safe hands. But when you invest or when you deposit money to a company, then at that time you don't have any security against your funds. So there is insecurity every time. Then the third one is no voting rights. Means you can deposit money in the in the company, but you cannot take part in the decision making process. You don't have any voting rights. Even if you think that the management is not working properly, then you cannot say anything because you don't have any voting rights. Now there are some government regulations about these public deposits. Now let us see. Some company indulge into malpractices such as non-payment of interest, non-refund of the deposits, and dishonoring their commitments and obligations. Because of these things, the government had to intervene, and they had made some rules and regulations regarding these public deposits. And these rules are known as Companies Acceptance of Deposits Rules. Now let us see what are those. Now the first one is maximum deposit. Ordinarily, total public deposits should not exceed 25% of the paid up capital and free reserve of the company. Means these rules and regulations, they have kept a bar up to which a company can take public deposit, and it is fixed as 25% of the paid up capital or the reserve of the company. They cannot take public deposit beyond that 25%. The next is period of deposits. For how long a company can keep public deposit. It is fixed as minimum 6 months and maximum 36 months. After 36 months, they have to repay back the public deposits. Then register of deposit. Every company procuring funds through public deposit must maintain a register of deposit showing the name, age, address, occupation of the depositors, amount and period of deposit, rate of interest, date of refund, and other material information. So every company, they have to keep a register in which they have to furnish all these details of the depositor. Then the next is rate of interest. Maximum rate of interest on public deposit must not exceed 15%. If the depositor withdraws the money before the due date, that is, means suppose if a depositor has kept his money for 12 months, then if he wished to withdraw before 12 months, then that interest of amount earlier, suppose if he was supposed to get 15%, that will be reduced by 1%, and that time he will get only 14% of interest. The next is maximum brokerage. Brokerage payable on public deposit must not exceed 10% of the public deposit. Means sometimes you hire broker to raise fund through public deposit. In that case, that time you cannot pay more than 10% of the public deposit as brokerage fee. The next is tax deduction at source. If the interest exceeds the sum of 2,500, tax must be deducted from the interest. If the depositor declares that his income is lesser than the taxable limit, tax may not be deducted. Means while receiving interest, if your interest amount is more than 2,500, then the company itself, they will deduct tax amount from your interest money, and after that only they will give you the remaining interest. But suppose if you are a depositor and you prove that your income is lesser than the taxable limit, that is 2,50,000 as per now, that at that time your tax will not be deducted from your interest money. Then next is advertisement. The advertisement inviting public deposits must be made in one English and the other in the regional language newspaper. It must contain material information. Its copy must be filed with the registrar of companies. Means you cannot just speak, you cannot just inform through your mouth that your company is going to take public deposit. You have to give proper advertisement, one in English newspaper and one in a regional language newspaper, and in that advertisement you have to furnish all the material information of the company, as well as that copy must be filed with the registrar of companies. Now there are another source of raising fund, and that is loans from financial institutions. After independence, we adopted planned developmental economy and initiated the task of rapid industrialization. As we all know that after independence, India, they focused on industrialization. In order to achieve this objective, the problem of acute shortage of funds was felt. Means for industrialization, the companies, they needed a lot amount of funds, especially long-term and short-term finance. As a remedy, government established several specialized financial institutions just for helping the industries. Now, what are the objectives of institutional financing? The first objective is meeting long-term and medium-term financial needs of the company. The next is building and strengthening capital market in the country. Then balance regional growth. They should focus on development of all the regions of the country, not just focused on one region. The next is accelerating the pace of industrial growth, means to speed up industrial growth in the country. Now there are some important financial institutions that we can take loan if you are planning to start your business. Now let us see what are those. First one is Industrial Finance Corporation of India, IFCI. Now for multiple objective type question, you can by heart the full form of these banks, because of this institution, because sometimes they used to ask for 1 mark. The Industrial Finance Corporation of India is the first financial institution established in the country on 1st July 1948. Means in India, the government, they first started IFCI with the objective of helping industries under a special act of parliament, and it was established on 1st July 1948. The main objective of IFCI is to provide medium and long-term credit to eligible industrial concerns in the country. Now let us see what are the objectives and scope of IFCI. The main objective of the corporation are to render financial assistance to industrial concern for a period not exceeding 25 years. Means they will help financially to industry, but up to 25 years only. Beyond that, they will not help anymore. So you have to by heart these objectives as well. The next one is to guarantee loans raised by industrial concerns. To guarantee loans raised by industrial concerns in the open market. Means if a company is, or if an industry is planning to raise funds through equity or debentures in the stock market or open market, at that time this IFCI, they can guarantee loan through means they will give loan to the company for raising fund through equity and other shares. To underwrite the issue of stock, bonds, shares and debentures by eligible industrial companies. Now underwrite means, suppose your company is planning to raise 10 lakh through raising equity shares, raising 10 lakh rupees through issue of shares, but somehow you were able to only raise 5 lakhs. In that case, the remaining 5 lakh will be shares of 5 lakh, remaining 5 lakh rupees will be brought by IFCI, and that is known as underwrite. If a company cannot raise targeted amount of fund through equities and debentures, then in that case IFCI will come in aid and they will purchase the remaining shares, and that is known as underwrite. The next is Industrial Development Bank of India, a unique institution. The Industrial Development Bank of India was established in July 1964. It was brought into existence at a time when there were already a number of institutions in the field for providing industrial finance. The reasons why yet another institution had to be brought into existence are as follows. Means by the year 1964, there were already so many institutions for providing industrial finance, but still this IDBI was established. And why? The reasons are the existing of financial institutions such as IFCI, ICICI and SFCs did not have enough resources of their own to meet the fixed and working capital needs of the industrial concerns of long-term basis. Means these institutions like IFCI, ICICI and SFCs, they cannot help a company for providing loan or financial assistance for long-term basis, and that is the first reason why IDBI was established. Then secondly, the commercial banks, though having no shortage of investable funds, means they have funds, were not keen to undertake long-term finance, even though they had funds, but they were not willing to give for long-term loan because of the absence of adequate refinancing arrangement, because they were feeling insecure that if they provide long-term loan now, whether they will get their money back or not. This affected their liquidity position. Thirdly, each of these institutions functioned in an uncoordinated manner, means there was no coordination between these institutions, following different policies as to lending and investment of funds. They did not follow any particular or same lending and investing policies. They used to follow different rules, and that is why they do not have any coordination, and in that time IDBI came into rescue for the industrial concerns. Then, with the enactment of the Public Financial Institution Amendment Act 1975, the IDBI has now been made the apex, means the main important financial institution to aid and control the functioning of other financial institutions. Means IDBI, they used to control and help other financial institutions. Now, what are the objectives of IDBI? Now, first one is to coordinate, means to bring coordination between different financial institutions, to help them in regulations. To regulate means to provide regulation, rules and regulations, and to supervise the activities of IFCI, ICI, UTI, LIC and other commercial banks. Now you have to understand, or you have to by heart the full form of these banks or institutions. The next is to supplement the resources of other financial institutions and thereby widen the scope of their assistance. Means IDBI, they provide financial help to other institutions so that those other institutions, they can lend loans to the industries or companies. The third one is to plan and promote key industries and diversify industrial growth. Means IDBI, they help in planning and promoting industries, those important industry, as well as they try to bring industrial growth in all the areas. They do not focus on keeping industrial growth in one particular region. Then the last one is to devise and enforce a system of industrial growth so as to conform to the national priorities. Means they use several methods. They try to bring development, industrial growth, so that the regional development is in coordination with the national development. Then next institution is Industrial Credit and Investment Corporation of India, that is ICICI, or we know ICICI Bank. The Industrial Credit and Investment Corporation of India was established in January 1955 to provide financial assistance to industrial units in private sector. Means they mainly focus on private sector industries. It is true that financial institutions other than ICICI set a part of their funds for assistance to the private sector. The available evidence showed a lion's share of these funds went to public sector. Means other institutions, they used to focus more on public sector, with the private sector only getting a pittance. Means a major part, or you can say lion's share, was given of fund was given to the public sector, but private sector they hardly used to get any assistance from financial institutions. Further, most of these financial institutions provided only a limited amount of risk capital, and this together with a strict legal framework within which they worked and created hurdles for the private sector units in securing necessary financial assistance. Means since major portion of the funds used to go to the public sector, private sector was shrinking. They did not get any sufficient amount of assistance from any institution, and that is why ICICI was established. Now let us see what are the main objectives of ICICI. To assist in the formation, means to help in forming, then expansion and modernization of industrial units in the private sector. The next is to stimulate and promote the participation of private capital, both Indian and foreign, in such industrial units. Means through ICICI, private sector were able to raise funds through Indian and foreign exchange market. The next is to encourage the expansion of investment market in India. Means they try to expand, or they encourage to expand the investment market in India, that is capital market or stock market, you can say. Then the next is to furnish technical and managerial aid so as to increase production and expand employment opportunities. Means ICICI, they used to help industries in making technical development as well as managerial development, so as they can increase their production as well as they can generate employment to the people. Then the next one institution is Unit Trust of India, or UTI. In India, there is no dearth of people who are able to save a little and who would be welcome investing their saving in shares and debentures issued by companies. If they are not always able to do so, it is either because their savings are too small or because they do not know much about where and how to invest their savings. Now in India, we don't have that much knowledge of investing in share market. So even if people who want to invest in share markets, they think that you need a huge amount of money to invest, or you don't know how the share market works, and that is why we don't feel like investing in share market. However, if the savings of all such small savers are collected, this would amount to sizable figure, and then their investment in shares and debentures would not only benefit the companies and promote industrial development of the country, but also fetch a handsome return to the small investors. Sometimes when we have small amount of money, so all the people's small saving, they can be collected together and then can be invested in the share market, and in return the company, they will provide interest to the investors. It was with this end in view that the government established the Unit Trust of India. So the government, what they did is that they established Unit Trust of India. Now when was this UTI established? It was established under Unit Trust of India Act 1963, and it started its functions on 1st July 1964. Now what are the objectives of UTI? The basic objectives of UTI are: the first one is to stimulate and pull together the savings of people belonging to middle and low income groups. Now those middle class people or low income group of people, those who have small savings, UTI, what they do is that they try to encourage them to invest into the share market, and what they do is that they pull together, means they collect all these middle and low income groups people together. Then to enable such people to share the benefits of investment in the ever-growing number of businesses and industrial concerns in the country. So what UTI they do is that it helps people to get the benefits of share markets or investing in the business. Okay, most of the people, we don't think that investing in share market is a good method of earning money, but it is. So you can invest through UTI as per your convenience. Even though you have small amount of money, it doesn't matter, you can invest in the business world. Then what are the chief characteristics of unit trust? The first one is unit trust reduces risk of investors. Since you are investing through UTI, it reduces your risk. Then generally UTI has professional management, means they have professionals who can guide you where to invest money so that you will get fixed return. Okay, so they are the professionals, they have training, they have all the knowledge of share market. Then investment in the unit trust is to diversify investment. Most of the people, we invest money through bank. We used to save money in our bank account, but UTI, what they do is that they used to diversify those investment from bank to share market. Now what are the advantages of unit trust? Risk of small investors is diversified with the unit trust, means those small investors, their risk are minimized with the help of unit trust. Then they increases investors capital with the help of professional management. Means since you are investing through professional management, investor, they are pretty much sure that their capital will be safe with them. Then the next is unit trust provides liquidity facility to the investors. Means whenever you want to withdraw your money, you can withdraw anytime, so that you have liquidity. Means you will have cash in your hand whenever you want. The next is disadvantages of unit trust. There are chances of breach of faith. Means even though the funds are managed by professionals, but sometimes there is breach of faith. Means you cannot have full faith on those professionals because everybody tends to make mistake. Then risk of fall in the value of shares. Means if the value of shares of a particular company falls, then your risk will also gets maximized. Means your money will lose its value. Then there is one UTI fiasco. The UTI, the largest mutual fund with a unit capital of 12,786 crore as on June 30, 2001, shattered the myth that all is well in the mutual fund industry. At that time, something happened in the mutual fund industry. It made investors nervous and dampened the capital market sentiment. Following cases are said to be responsible. Means why the stock market crashed, capital market crashed. Let us see. Retaining technology stocks even when it lost. Now these are some cases, and it is not that much important, but you can give it a reading, but it is not important from your examination point of view. But still you have to understand that on June 30, 2001, something happened. UTI fiasco happened, and it shattered all the myth. Means there was a huge downfall in the capital market. Now the last one is NSIC, National Small Industries Corporation of India. Formation: the National NSIC was established in February 1955 as a private limited company. Its objective is to promote and protect the small industry. As you can see in the name itself, it says Small Industries Corporation. Means its objective was to promote and to protect small industries by providing them financial assistance. Means through providing financial help for the purchase of machinery and equipment. It supplied the machinery on hire purchase system and also working capital. Now these were the 5 financial institutions which help industries to grow. Now let us see loan from commercial banks. Finance raised through commercial banks is known as bank credit or bank finance. Banks are the sources of short-term finance. Sometimes they may grant medium-term finance. Bank finance may be both secured and unsecured. Now what are the different forms of unsecured loans? The first one is overdraft. It is an arrangement of the current account holders with the bank to withdraw. As you have already know what is meant by overdraft in accountancy, this facility is given to current account holders only. Then next one is cash credit. It is a popular source of financing reputed firms. The specified amount sanctioned as loan is credited to the customer's account. He is allowed to withdraw as per requirement. Interest is charged on the amount withdrawn. Means suppose if you want to take cash credit, then you have to open an account in the name of your firm, and then you can apply for the cash credit. Suppose if you are applying for 10 lakh rupees, then that amount 10 lakh will be credited in your firm's account, and from there only you can withdraw as per your convenience and requirement, and they are going to charge interest on the amount withdrawn. Then the next is discounting bills. In order to tide over shortage of funds, customer can discount their bills receivable, that is, can borrow from the bank on the security of bills and promissory notes for a short period. On the due date, the bank presents the bill to the drawee and receives the amount. The bank charges interest on the amount of the bill for the period between the date of discounting and the due date of the bill. Now discounting bill means, suppose if you have purchased goods from your supplier on credit. Now you have written a bill saying that you will pay the amount on after 3 months, and you will pay that, you will give that bill to your supplier. Now supplier, when he is in need of cash, he can take that bill to the bank, he can withdraw, he can encash it, that bill, and bank, they are going to give him some amount of money after deducting or after discounting or after deducting some amount as discount, and on the maturity date the bank will collect from the bank will show that bill to you, and they will collect the amount written in the bill from the customer. Now let us see what is bank finance. Our commercial banks have these days started granting medium-term loans on the security of assets. These loans are granted for a period ranging between 1 to 10 years. While granting term loans, the banks takes into consideration the credit worthiness. They will first check whether you, how much credit worthiness you have, and the future prospects of the proposal, means taking loan. Okay. Commercial banks have also started subscribing for shares and debentures of the company. In this way, banks have entered into long-term financing. This attitude is welcome development for our industrial growth. Now let us see what are the advantages of financial assistance from bank. The first one is secrecy. Secrecy of the business can be maintained by borrowing funds from the banks. It is the duty of the bank to make finance deal with its customers a secret, means the amount or the loan that you have taken from the bank, it will be kept as secret. Then drawing amounts according to the needs. In case of short-term loans from bank, the amount sanctioned as loan is credited to customers' account. Means when you take loan from bank, they are not going to give cash in your hand. They will open an account and they will deposit that loan amount into that account, and from that account only you can withdraw money as per your convenience and as per your requirement. Then next is economical. Both finance is economical because it does not require preparation, issue and filing of documents. Simple negotiation with the bank is enough. It is less time consuming also. Then next is flexibility. There is a facility to withdraw amount as per requirement. Loans can be repaid in installments also, like EMI, easy monthly installment. Such flexibility is not available in other means of financing. Means in debentures you have to pay the amount in full, but in case of bank you can repay back your loan in installments. Then next is cheap. Bank finance is cheaper also because loan sanctioned is withdrawn as required and the interest is charged on the loan availed. Means the amount that you have actually withdrawn from bank only, they will charge interest on that and not on the whole amount for which you have taken loan. So it is considered as cheap. Then next is non-interference in the management. Since the bank, they are not your equity shareholders, they are not going to meddle in your management work. The next is simplicity. Many legal formalities are required in case of procuring funds through shares, debentures and public deposits. In case of finance through banks, such legal formalities are not required, so it is simple to procure funds through bank. Means when you raise funds through shares, debentures and public deposits, you have to undergo many legal formalities, but in case of bank loan you don't have to go that much legal formalities. You just have to fill all the forms in the bank. Now let us see the demerits of bank finance. The first one is unreliability. Bank may refuse to grant loan and renew loans when it is urgently needed. As such, bank finance is unreliable. The next is fixed charge. Interest on bank loan has to be paid even if there is loss. Means you cannot escape the loan saying that your business has suffered loss this year. You have to pay your interest. Then charge on assets. Bank loans are granted after mortgaging assets which cannot be used for borrowing additional loans. Means you have to pay you have to keep some of your assets as security, so that if you are not able to pay loan, then the bank, they will get a hold of your assets. Now the next one is trade credit. It is very simple. Credit granted by suppliers of goods for short term known as trade credit. Suppose if you purchase goods on credit, it is known as trade credit, and in actual practice most of the enterprises, they don't take immediate payment, thus it is form of credit sanction. Trade, as we know, trade credit is the purchase and sale of goods on profit motive. So the trade credit strictly refers to the routine business activity. So this trade credit is given for a short period of time and not for a long time. But for granting this kind of credit, also a supplier, first they will see the goodwill of your business and your credit worthiness of the enterprise. Now, what are the merits of trade credit? It is convenient source of short-term funds. One can buy goods without blocking his capital, as trade credit allows to pay in the future. No immediate payment is needed, means you don't have to make immediate payment. You can pay after some time in future. Then it is immediately available, especially when the creditworthiness of the other party is good. It helps in promoting exchange of goods and services. It does not create any charge on assets of the firm. You don't have to keep any assets as security for availing this kind of credit. Now let us see what are the demerits of trade credit. It may lead to overtrading and stockpiling, means you can keep on purchasing at credit, and it will lead to the stockpiling, means your stock will get since you are purchasing in credit, your stock will get in abundance, means you keep on piling your stocks whether you are selling them or not. Very restricted finances available through trade credit, means most of the time you cannot get trade credit from your supplier. Buying goods on credit can harm future goodwill and credibility of the firm. Now the next type is intercorporate deposit. An intercorporate deposit is an unsecured loan extended by one corporate to another, means it is a deposit given by one corporate or one industry to another. It helps the fund surplus corporates to lend to other corporates. Suppose if your business has extra or surplus fund, then you can lend it to the other business who they need. Okay, the cost of raising funds through ICD is much higher than other sources of finance, and since they are unsecured, hence the risk involved is very high. The ICD market is not very popular, and therefore very little information is available about transaction details. Means while raising funds through ICD, it is much higher, means you have to pay higher rate of interest on that kind of loan. So that is why it is not that much popular and very little information is given. It can be identified as deposits made by one company with other and generally carry a term of 6 months. ICD can be classified into 3 categories, namely 3-month deposit, 6-month deposit and call deposit. Means deposit for 3 months, for 6 months, and deposit for call, means whenever 3 months deposit are usually considered by borrowers to solve problems related to short-term capital inadequacy. Such kind of cash problem may arise due to tax payment. Interest on this 3-month deposit is 12%. Now let us see 6-month deposit. 6-month deposits are generally made with first class, and as the name suggests, the term for such deposit is 6 months. The annual rate of interest is 15%. Call deposits are different from previous 2 deposits. They can be withdrawn by the lender on giving a 1-day notice. Means suppose if you have lended some money as call deposit to another industry or another company, then today you can give notice that you want to withdraw your money, and tomorrow you can take back your money from the company. The annual interest is 10%. Now let us see what are the various factors that affects our decision of taking which source of funds. Now the first one is cost. Both the cost of acquiring funds and the cost of utilization of funds should be taken into consideration. Means first you have to see how much amount of money that you are going to spend and how much amount of interest you have to give to the debenture holders, equity shareholders or preference shareholders, or giving interest on your loans from the bank. So those things you have to keep in mind before choosing your source of finance. The next is financial strength and stability of the operation. Financially strong and stable enterprise can venture to obtain funds by issue of fixed charge securities such as debentures and bonds. Means those companies who have strong financial position, they can go for debentures and bonds. But in case of in the enterprise who are financially weak, they should prefer obtaining funds by issue of equity shares, because they don't have to give regular dividend on equity shares, whereas there is no fixed charge of interest. Then the next one is form of organization and legal status. It is the form of business which also decides the source of funds. Suppose in case of sole proprietorship and partnership, they can obtain fund by loan, but they cannot raise loans and they cannot raise funds by issuing debentures and equity shares. Then the next one is purpose and time period. Short-term loans can be obtained at low rates, because since you are raising loan for short-term needs, you can go for low rates, okay, through trade credit and commercial paper, etc., like bill discounting bills. But for long terms, you can issue shares, debentures, and you can go to institutions for loan. Then long-term business expansion plan should not be financed by a bank overdraft, which is required to be paid within short period of time. Suppose if you are planning to take long-term expansion of your business, then you cannot take bank overdraft, because bank overdraft amount you have to pay within a short period of time. Then the next one is risk profile. Risk involved in the source must also be taken into consideration. In case of equity share, no risk is involved, because the funds have to be repaid at the time of winding up, and dividends need not be paid if there is no profit. In the other hand, equity shares, there is no risk involved, because like you have to repay back only at the time of winding up, and dividend also you don't have to pay regularly. But in case of loans, you have to pay. There is repayment schedule, means after 1 year, 2 year, or 3 year, you have to pay principal as well as interest, plus you have to pay loan regularly irrespective of your profit. So there is risk profile as well. Then next is control. The business must decide in mind the extent to which it would like to share the control of business. Means if you want that, you don't want to share your decision taking, if you don't want your shareholders to take participate in the management, you can go for debenture holders. But if you want your shareholders to take decisions in the management, then you can go for equity shares. Shares carry voting rights, which may affect the control of business. In case the business does not desire to share control, it should obtain funds by issue of debentures and raising loans. Then the next one is effect on creditworthiness. The issue of secured debentures may affect the creditworthiness of the business. It may adversely affect the interest of unsecured creditors. Means when you keep on raising funds through issue of debentures, the equity shareholders, they will feel insecure, and they will feel hesitate to invest further in the business. Then the next one is flexibility and ease. The preference of the source of funds is also affected by the considerations such as restrictive provisions, detailed investigation and documentation in case of borrowings from banks and financial institutions. The source is preferred which has got more flexibility and ease. Means people will like to take loan from a particular place which has lesser paperwork, less difficulty, less rules and regulation, plus whenever they want to raise additional capital, they can get through. Then the last one is tax benefit. Now the interest paid on debentures and loans is deductible for the assessment of tax. It is as such preferred by enterprises seeking tax advantage. Means a company also, they have to pay tax on their profit, but like when you pay interest on debentures and loans, you can deduct that amount from your tax and you can avail tax benefit. Means you can show your less profit after deducting interest that you are supposed to pay to debenture holders as well as your financial institutions for the loan that you have taken, and after deducting some amount from your profit, you can show less profit in your tax evaluation, and hence you have to pay less amount of income tax. Preference shares may not be preferred because dividend paid on these shares is not deductible for calculation of share. But in case of preference shares, you cannot deduct their dividends before calculating your income tax. Means you have to include their dividend while calculating your total income of a particular period. Okay, so it means debentures and loans, they get tax benefit, but other preferentials, they do not get tax benefit. Now I hope you understood this chapter. So for this session we will wind up here. Thank you.